Hey everyone, welcome to this explainer. Today we're grabbing our magnifying glasses and putting on our detective hats. But instead of dusting for fingerprints at some crime scene, we're hunting down the truth in a world of numbers. We're going to become financial detectives, diving right into the fascinating, high-stakes world of auditing.
I mean, really think about it for a second. When some massive corporation claims they made millions in profit this year, or they brag about owning vast factories all over the globe, how do the shareholders actually know they aren't just, making the whole thing up? People can be deceptive, numbers can be pretty easily manipulated, and investors need someone they can absolutely trust. They need an independent detective to step in and actually verify those claims.
Okay, so here's our roadmap for today. We're going to cover 1. What is an audit? 2. Following the paper trail. 3. Verifying assets and liabilities. 4. Vouching versus verification. And 5. Keeping track the registers. Let's get right to it.
Section 1. What is an audit?
Believe it or not, the word audit actually comes from the Latin word audiere, which literally means to hear. Back in the day, accounts were literally read out loud to an official who would just sit there, listen, and verify them. Kind of wild, right? Fast forward to today, and an audit is an independent examination of a firm's financial statements. The absolute key word here is independent. The auditor isn't just some company employee rubber stamping the CEO's numbers. They're an objective third party expressing a professional opinion on whether the financial records are accurate, fair, and compliant with all the accepted rules.
So why does this matter so much? Well, audits are basically the bedrock of financial trust. They bring some much-needed credibility to financial statements, which means stakeholders can actually believe the numbers they're looking at. But it's not just about looking good on paper. Audits are a critical line of defense for fraud prevention and detection. A strong internal audit system acts like a financial security camera, deterring employees or shady vendors from trying to rip the company off. Plus, reducing the risk of a financial misstatement can actually lower a company's cost of capital. Why? Because banks and lenders simply trust them more.
Now, there's a really interesting distinction between the two main types of audits, especially when you look at countries like India. On one side, you've got the statutory audit. Think of this as the legally mandated official external report card. It's for the government and the shareholders, and it has to be done by external, independent professionals. On the flip side, we have the internal audit. This one is more like a routine health checkup requested by management to make sure daily operations are running smoothly. And unlike the statutory audit, this one can actually be done by the company's own employees.
Section 2. Following the paper trail. You know, every single transaction leaves a footprint, and in the accounting world, we call that footprint a voucher. Now, a voucher isn't just some random scrap of paper. It's the documentary proof that totally authenticates a transaction. Whether we're talking about a sales invoice, a bank statement, a cash memo, or just a physical receipt, it's the foundational evidence that a transaction actually happened and is 100% genuine. Basically, no voucher, no proof.
And that brings us to the action itself, vouching. Vouching is the active process of analyzing all those business vouchers, and it's universally considered the absolute backbone of auditing. Why is it the backbone? Because this is exactly where the auditor catches errors and sniffs out deliberate frauds. Vouching ensures that an accountant hasn't just invented some fictitious transaction out of thin air to pocket the cash. It proves that the daily gears of the business are turning honestly.
So, how does an auditor actually pull this off? It's a super methodical, step-by-step process. First, they arrange all the vouchers and meticulously check them against the accounting books. Next, they compare the dates, making sure the words and the figures match up perfectly. Third, they kind of act like handwriting experts, verifying the signatures of authorized officers. Fourth, and this is a really big one, they make sure the transaction actually relates to the business. An auditor is definitely not going to accept a voucher for a personal luxury vacation written off as a business expense. And finally, they compile a list of any missing or canceled vouchers. Because let's be honest, what's missing is often just as revealing as what's actually there.
All right, Section 3. Verifying assets and liabilities.
Think of it this way. If vouching is checking the daily receipts, verification is making sure the giant warehouse you just bought actually exists. Verification is the auditing process of confirming the physical existence of the assets and liabilities listed on the balance sheet. It's definitely not enough for a company to just say they own a piece of million-dollar machinery. The auditor has to step in and confirm it physically exists, that the company legally owns it, that it's in their possession, that it's valued correctly, and maybe most importantly, that it isn't secretly weighed down by some hidden debt.
There are two main ways our financial detectives verify these claims. First is off-site verification, which involves reviewing official records, checking the paperwork, and even interrogating workers remotely right from a desk. But sometimes, you just have to see it to believe it. That's where on-site verification comes into play. This means the auditing party actually travels to the facility to physically inspect the premises and see the assets with their own two eyes.
So what's the ultimate goal with all this? The objectives are pretty clear. Confirm the asset exists, prove legal ownership, check that the purpose was actually authorized, make sure no liabilities are left out, and confirm the valuation is spot on. But what's the real so what for a business? Well, proper verification means shareholders have a safe investment. A clean, completely verified balance sheet builds incredible trust. It makes it vastly easier for a company to secure bank loans or even get the right insurance payout if disaster ever strikes.
Which brings us to Section 4, Vouching versus Verification.
Let's put these two head to head. Vouching examines the daily transaction entries in the books, while verification examines the final assets and liabilities on the balance sheet. Vouching is this ongoing process done throughout the entire year, usually by junior audit clerks. Verification, on the other hand, happens right at the end of the year and is handled by the senior auditor or their direct assistant. Also, vouching doesn't really concern itself with the valuation of an item, whereas nailing down the exact valuation is a fundamental part of the verification process. If you want to boil it down to a single, memorable takeaway, just remember this. Vouching tests the details of daily transactions as they happen, while verification tests the reality of your final year-end balances. One is meticulously tracking the journey, and the other is confirming you actually arrived at the final destination.
Finally, Section 5. Keeping track. The registers.
First up, we have the stock register. This is a crucial database that tracks the entire history of a company's stock offerings and exactly who owns those shares. If a shareholder unfortunately loses their stock certificate, the stock register steps in as the ultimate authority to validate their claim. It makes sure dividends are paid out to the right people, it tracks voting rights over time, and it serves as a hugely important historical resource for the whole company. Then we've got the asset register. Think of this as the ultimate master inventory system. It's a thorough, incredibly detailed record of every single physical asset a firm owns. It tracks an asset's entire life cycle, literally from the day it was bought and its original price to its exact physical location today, its current condition, and exactly how much it is depreciated over time. Now, keeping an asset register perfectly updated might sound like a bunch of tedious admin work, but get a load of this number. Having an accurate, comprehensive asset register can actually boost a company's sales and cash flow by an incredible 5 to 18%. I mean, that is a massive impact on the bottom line, and it's achieved simply by knowing exactly what you own and how to use it effectively. How does it actually pull off that kind of financial boost? Mostly by providing complete transparency. An updated asset register ensures regulatory compliance. It stops valuable equipment from conveniently getting lost or stolen, and it helps accurately forecast future maintenance costs. And for our financial detectives, it provides a perfectly accurate, airtight audit trail that makes the entire verification process smooth and totally undeniable. We've definitely covered a lot of ground today, from the daily vouching of receipts all the way to the year-end verification of massive physical assets. So, I want to leave you with this provocative thought. If an independent financial detective walked in and investigated your business, or hey, even your personal records, today, what hidden truths would your paper trail reveal? Would your vouchers be perfectly in order, or would there be some missing pieces to the puzzle? Sound internal controls and crystal clear registers don't just keep you compliant, they keep your entire financial house standing strong. Thanks so much for joining me on this explainer, and remember to always keep asking the right questions.